We are proud to present Shares Program, Sharing Not Borrowing, Finance Solution Without Usury. Are short sale and loan modification the right solutions? Well, since the financial crisis in 2008 and until today, the financial industry and governments in USA had proposed two solutions for real estate mortgages tragedy. Those are short sale and loan modification. Consequently, the US government issued an emergency fund of $190 billion, then $750, and lately another $600 billion in order to rescue this continuing falling down crisis, especially the real estate mortgage industry. Therefore, we like to present the pros and cons of these transitory unstable real estate mortgage programs. Then compare them to our shares program as a sustainable solution based on sharing not borrowing concept. This study is done by Dr. Ibrahim Halawi and Michael Stewart from the American Institute of Real Estate, Virginia. First program, short sale. Short sale, by definition, is a sale for a property with current market price is lower than the property loan amount. The lenders nowadays agree for such sale to a new buyer without going after the current borrower for the difference and releasing him from bad mortgage debt, providing a fresh start without damages to his credit report. Can anyone tell the difference between two borrowers who are facing the short sale? Borrower number one who put 30% down payment and borrower number two who put no down payment. Both of them are losing their homes under the same program, short sale, if you do have an equity or not, with full protection of the credit report. Lesson to learn from short sale. Lenders are sharing their loss with borrower by government financial support. Lenders and government are encouraging borrower to always put no down payment or the minimum down payment required, then no equity will be built up. Always cashing any increased equity at any time. Unfortunately, no home ownership for retirees to use in their retirement later on. Then who's killing the American dreams? No save the property to cash out retirement money. Second finance solution is loan modifications. By definition, it is a permanent change in one or more of the terms of the loan, give the borrower a fresh start, and results in a payment that he or she can afford. The sole purpose of a loan modification is to enable borrower to meet the terms of the new loan for the foreseeable future to comfort the borrower. Then finally, lenders are sharing borrower's problems. Loan modification pros: lower the current interest rate, lower the payment, reduce the balance of current loan, eliminate late payments and penalties, modify adjustable rate to a fixed rate, stop foreclosure process, no lawsuit brought against borrower by lender, and the mercy agreement. Same talking here apply. Keep the borrower carrying on all the risk of the new loan and free the lender from any potential liability as well. After the Great Depression in the 1930s, loan program had moved from using simple interest program and formula to amortized formula. This table here shows the amortized program of all loans payment programs, including loan modification, called reducing loan amount. But actually, it is called compound interest rate when we can see the balance is reduced all the way to zero. This graph here shows the amortization program loan with a decreasing balance program, which always has a major problems. If the purchaser is in default, the payment to lender interest will be added to the balance and charge extra additional interest, even though in loan modification, purchaser payment have no protection at all, as well as his equity is always at risk. This table here shows a loan of $1 million for 20 years with 8% interest. If the purchaser is missing 3 payments here of $25,000, it accumulates to 15 payments with $125,000 extra balance. This new graph here shows increased balance, extra interest usury, even for loan modification. Purchaser is exposed here to add missing payment to the balance and paying new interest on the interest as usually. Then decreasing balance payment here, actually it has a triangle payment where the side are the interest, and purchaser is confused. Is this a dinosaur program with tail? How the problem had started. In fact, all lending programs use simple interest with fixed loan amount. When the property fluctuates up and down here, when the property value fluctuates and when the property depreciates lower than the market value, that leads to Great Depression in the 1930s. Then, loan amortization program had invented around 1940s and uses until today. As long as the loan balance is less than the property value, lenders are happy. But if the loan balance was higher than the property market value, this causing the major mortgage problems affecting the whole world as well. To conclude, lending program, it starts using simple interest formula leading to Great Depression in the 1930s, then using amortization formula causing the current mortgage crisis, then loan modification still using the same compound interest formula, which will always leading to new financial catastrophes later on, but it is matter of time. The solution. This table here shows the conversion of finance to shares. If a property worth of $125,000, we convert it to 14.1 share. The down payment for $25,000 converted to 2.8 share, and the loan amount is converted from $100,000 to 11.26 shares. This table here shows the decreasing balance of the lender from 11.26 shares all the way to 0, and the buyer share increased from 2.8 all the way to 14. This graph here shows the decreasing shares of the lender and the increasing shares of the borrower. This graph here shows how purchaser buy more lender's share and gain time and money, or loses share when he is in default. Share programs here table explain the conversion to shares between buyer and lender. In the event purchaser misses the 3 payments here, they will be deferred to later time without any extra money. The $25,000 here will be added to here without any extra time or money. This graph here shows property appreciation and equity built up distributed between the purchaser and the financier here based on their shares ownership. As here we have $50,000 of appreciation, it will be distributed proportionally between the lender share 10 and the buyer share 4. This graph here shows distribution of any equity when the appreciation of a property fluctuates and up. Any kind of equity. Shares program moved the risk from horizontal risk to vertical risk. What does this mean? If the property worth of $100,000 with 30% down payment, if the property depreciates 30%, then his down payment here is wiped out, gone. The lender will take here the 70% of the loan amount. But if the purchaser here down payment, with the vertical risk here, if the property depreciates by 30%, the borrower will lose 30% from his down payment or equity, and the lender will lose 30% of his 70% equity or down payment. If a property worth of $100,000, then the purchaser will lose $9,000 and the lender will lose $21,000. Same talking. When a property appreciates by 30% equal to $30,000, here the appreciation will be shared between the buyers and the lender, or the borrower and the lender. The $30,000 will be distributed at 30% to the buyer equal to $9,000, and the 30% to the lender equal to $21,000. Well, let's see other existing mortgage program here, like the reversed one. Reverse mortgage is the home loan for seniors only, 62 years plus, which allow them to convert a portion of the equity in their home into cash paid back to them. Seniors should not have sufficient or even income to qualify for this loan. They are not required to make monthly mortgage payments sometimes. Borrower cannot be foreclosed or forced to vacate their principal house because they are missing a mortgage payment. The loan is not due as long as the house is their principal residence. But the cost of acquisition is being expensive, and it uses a compound interest formula program as well. Second program here, ARM, Adjustable Rate Mortgage Program, is a mortgage with an interest rate that may change primarily to bring the interest rate in line with market rates, which might be reset annually in order to compensate the lender and increase his return and the profit on the borrowed money. Note, shares program will increase the lender profit by the property shares value appreciation by time and not by increasing the rate of the interest by time. Third program here, shared appreciation mortgage called SAM, is a mortgage program in which the lenders agree to an interest rate lower than the prevailing market rate in exchange for a share of the appreciated value only of the collateral property. The borrower down payment is at risk and may be wiped out. If the property appreciates, both lenders and borrowers are profiting. But if a property depreciates, borrower may take the risk of downturn. Conclusion here for all those programs. Shares program integrate all these mortgage programs: short sale, loan modification, fixed rate mortgage, adjustable rate mortgage, and SAM reverse, and exceed their benefit to borrowers and lender beyond interest rate gain only to sharing appreciation and risk. In fact, shares program concept is based on three principles. First, protect the client, down payment, equity, and appreciation. Second, there is no accumulation of interest as usually. Third, vertical risk, sharing profit and loss. Shares program only respect purchaser position during the effect of the economic cycle. Economic cycle has 4 categories in 20 years. Purchaser is exposed to lose his job and stop paying his mortgage during this 20 years. Then which program is going to protect him? Your program is a shared program as a new solution. Shares program functions depending on each purchaser and the property condition. Shares program integrate the buyer down payment and the financial amount into its formula, which compute mathematically the value of each share for this purchaser, the total number of the share for this property, the proportion of shares ownership based on borrower installment during the term to own all lender shares until complete ownership without any usury. If purchaser is in default, he can sell his shares back to the lender without any usury or interest. It protects the purchaser payment, equity, and appreciations during the purchase term. When a sales take place during the term, the lender will share the borrower equity built up, usually positive as price increase due to inflation, land, and other costs. Shares program from landing history to leading history. Real estate problem is not only by finding a property, but by finding the right finance, convenient to the purchasers, affordability on the long term. Shares program now lead the change in this century. We welcome the opportunity to introduce the shares program and its formula to the decision maker in your organization, since we strongly believe this new discovery will change the way of financing by sharing, not borrowing, to protect the purchasers and increasing the lender profitability. Protect the future, protect the citizen, protect the country. Let's open the real estate bank, saving and investment. For more information, please contact us or visit our website at www.sharesprogram.com. Thank you.